Welcome back. Well, the strength in the market continues. So it's been a decent day for the Indian markets and the bulls at least. So Ultratech, Grasim, Wipro, M&M, Eicher Motors, these are the ones which are leading the chart and comfortably above that 23,200. But a stark underperformance from the Bank Nifty today. SBI, HDFC Bank, Kotak Mahindra Bank, these are the culprits. And of course, AU Small Finance Bank, which is down almost 3%. These are the reasons why Nifty Bank is languishing in the red. Ajay Vora, the head of equities from Nuvama Asset Management, also joins us on the show. Ajay, what to make of this weakness in some of the financials? The valuations, everyone says, comfortable. Worst, perhaps, with respect to asset quality is over. The competition from MFI and Sectoral also has come down. What then explains that people are still not interested in buying some of these financials afresh?
So I think good afternoon and thanks for having me on the show. I think it is clearly the lack of growth. So if you look at the largest private sector bank which reported the numbers, the NII growth was less than 10%, the PAT growth was around 2%. So I think till the time we don't get clarity on the growth, valuations may look cheap, but I think that is clearly not the reason for someone to get in unless and until we get more clarity on the growth coming in next few quarters.
Saying stay away even from large cap banks, Kotak, HDFC, ICICI, SBI, you're not seeing value anywhere?
So I think, see, as I said, the value is there, but you saw, a very different reaction for another private sector bank. So you have to pick and choose. My sense is that it depends on the composition of the book, and wherever we are not seeing any major downside in terms of the asset quality because of the composition of the book, or on the other hand, if you are looking at some sort of growth, because the growth rates anyways are no longer the 18-20% which we were used to earlier, that has now come down to around 10-12%. So I think wherever at the top end we are getting the growth, that is something which one can prefer.
So Ajay, from the earnings so far, what is it that you've liked? I mean, somewhere where you thought the earnings or growth visibility is better than what you anticipated, or the stock has fallen a whole lot and is now comfortable given the valuations?
So I think, see, honestly, the markets have corrected mainly because there is a complete negative surprise on the growth part, and therefore, so far the results which have come out, I don't think there is any silver lining to it. Only to some extent, if you look at it, the commentary from the IT companies has been a bit positive, saying that there has been pickup on the discretionary side, and therefore, there has been some sort of interest over there. Otherwise, not many companies, first of all, have reported numbers so far, so nothing on the auto side or nothing on the, I would say, capital goods side has reported numbers so far. So far, whatever has been the case has been from the banking and IT sector, which again, I would say has been very muted. And in some cases, there has been a negative surprise in case of, two large private sector banks.
So if you're saying, Ajay, that growth is a bit challenged and earnings have been subpar, what's the suggestion or recommendation right now with respect to investing? Are you telling people to perhaps keep the powder dry and wait for a further correction? Are you asking them to deploy in certain pockets? What would be your advice?
So see, actually, one has to get more visibility on the growth. So when we started the year FY25, we were expecting around 14-15% growth. Now that has come down to almost 4-5%, right? So we'll end FY25 with only 5% growth. Now, again, for FY26, we are building in 14-15% growth. So which, clarity is much needed and which we will get over next, maybe I would say 1 quarter or so. So if you look at it, the correction has started from the month of, I would say, anywhere between mid-September to October. So October till March, I would say a period of 6 months is something where the markets have corrected and maybe consolidating right now. So I think maybe another 2 odd months, 2 to 3 months, and we'll get more clarity on the budget side as well. I think another 2-3 months and we will get more clarity on that 14-15% growth if it is really feasible for FY26. And then if it is looking very much constructive, we are back to the compounding story. So I think that, a consolidation phase is going on. So anyone who wants to invest, I would say that wherever the growth numbers are getting upgraded and you are getting more and more visibility, that is something which you can start investing right now. Or maybe, something like banks, as we discussed, it's in a value phase right now. But you need to have a little bit longer term horizon to invest in banking as of now. So I would say it depends, what is your strategy, but, bottoms up ideas are definitely available in the market.
Cheap, right, Ajay? I mean, you've got to see also the price at which you buy growth or growth stocks.
Yeah, absolutely. Absolutely.
Right. So where is it that you see a balance between growth visibility and valuation comfort?
So I think, see, if you look at cement as a sector and what has happened to the sector over last maybe I would say 5 7 years, the entire sector has got derated in a very big way. And my sense is that now if the overall construction we are looking at real estate, lot of launches, and also on the infra side, the demand is likely to pick up over next 2 to 3 years. And the pricing also, if you see over last 5 years, the compounded pricing appreciation has been less than 3%. So my sense is that there is a lot of consolidation which has taken place in the sector. On top of that, demand has been a little muted so far, which I think is likely to pick up. And because the sector has got derated, I think the re-rating prospects are also there. So I think we are looking at cement as a sector which is more on the constructive side from here on.
As a pack looks interesting, but you talked about real estate, and the jury is out on that one because some of the headlines do suggest that the inventory is building up, and anecdotally as well, seems like some of the markets are saturated. Would you recommend people to book out some profits because the stocks have done rather well over the last couple of years?
Yeah, so actually, if you look at it, real estate has been one of the top performing sectors over last 2 years. And the whole story of, the branded players or organized players taking away significant market share from the unorganized had accelerated over last 2 years. My sense is that considering the, the million square feet what most of these guys have launched and sold over last 2 years, that is likely to soften a bit going forward, considering how the economy itself is slowing down. And therefore, I think that that sector again will go in a consolidation phase for maybe 6 to 9 months, and then again, it depends how the economy shapes up. Then we can get more positive on the sector. But I think that considering the pent up demand which was already there in the system has got very well absorbed over last I would say 2 years or so, and therefore a phase of consolidation is much needed for the sector from here on.
Okay, a bit of a phase of consolidation for real estate. What about consumption? How are you differentiating that within, let's say, the urban side, rural side, discretionary, and all of that? Because even urban is moderating a bit clearly.
Yeah, so clearly, the consumption at the top end is not seeing that kind of, I would say, a major negative impact as such. But obviously, the rural side or I would say, the lower middle class, I think the consumption is definitely lagging since a very long time, and that is something I strongly feel that needs to be addressed immediately, at least through the upcoming budget, because that is a very large part of the economy, and that is clearly giving signs of complete distress. So my sense is that because something which has lagged for almost I would say 1.5 year, if not addressed now, there can be a serious repercussions to that, because we having speaking to a lot of consumer companies, we are clearly seeing that capacities are getting underutilized. There is no pricing power, and therefore I think that at the ground level, some sort of stimulus is definitely needed in this budget, which can further accelerate this kind of demand at the lower end.
Through Ajay, that consumption bit, or it's not enough. What happens to the fortune of some of these consumption companies? So it's better to just wait it out?
Yeah, I think we are definitely in a wait and watch mode, although the stocks have corrected quite a lot, both on the discretionary side as well as on the staple side. But we are definitely on the wait and watch mode, because if it continues for another couple of quarters, I don't think valuations are still cheap. So we would definitely be on the sidelines right now.
Okay, Ajay, always good chatting with you. Thank you so much for your time today.
Yeah.
Okay, let's just revisit the markets before.